And we are back. My favorite day of the week is Tuesday because I get to chat with you live. And I'm talking about a really important topic to battle what we're seeing out there. I'm Lynette Zang, CEO and founder of Zang Enterprises, and we support you, our community, and sound money globally. We got to do it. Somebody's got to do it. That's us. So first I want to talk to you about two headlines that popped up this morning, which were perfect timing for what we're going to talk about today. One is, we're back. Equity trading crushes estimates as clean sweep. And so what they're talking about is what's important to the banks, which is trading. That's how they make most of their money. And wow, that's all that matters. Overvaluations, meh. Who cares about that? In fact, riskiest stocks begin an epic rotation with rate cuts in sight. Well, this is the most speculative corner of the stock market is soaring. Right, okay. Don't you remember the dot-com bubble, those of us that were alive and then, and what we were seeing didn't make any sense, and then that bubble popped and it took forever to regain that, and lots of money printing and devaluation, right? Well, I don't know. Frankly, this is all about transitioning us into a new system, and not only that, but even spot gold, we'll see where that closes today, 2460, new high. And all of this fabulousness is based upon the Fed cutting interest rates. Okay, because that's going to save it. I mean, they've been doing that for 53 years and it hasn't saved the system. At least it hasn't saved, I mean, it's pushed prices up in terms of this stuff, because that's what it does. But guess what? That banana you need to eat, it's still a banana, whether you paid 10 cents for it or you paid $20 for it. All right, let's just begin, because this is like ridiculous. Because what you really need to see is when Wall Street overtook Main Street, became more important than you and me, is whether or not those bankers make money, right? Screw everybody else. Oh, I probably shouldn't have said that. But this system, especially since 1971, is a system that is based on debt. We all know that. These gray bars are official recessions, and you can see that every time we hit an official recession, the speed at which we grew debt grows and grows and grows. There you go. I mean, does that look like a hockey stick to you? Because frankly, it looks like a hockey stick to me. It's exponential. And all that does is it makes this stuff that's out there worth less and less and less and less until it has no value at all. When do you want to protect what little bit of purchasing power is in there? Because this is what's going to do it for you. This is what's done it for thousands of years. Okay, so you see all the growth of debt, fine and dandy, but let's look at the stock market versus the GDP, gross domestic product. That is all the money that flows through the entire system. And we're talking about the US here, but I mean, does this pattern look kind of similar to this pattern? Because all of this wealth is based upon debt and inflation. And let me just kind of show you, because this debt becomes riskier and riskier, because at some point, what do you have to do? You either have to service it, you have to roll it over, you have to default on it, take your pick, or restructure it. This black line here is the GDP. You can see that from 1970 till we really had good liftoff in like 98, that it kind of ran parallel, the stock market kind of ran parallel to the GDP. But, you know, that all really kind of changed in 99 with the tech bubble. And you can see where it is right now, because it's really this debt and this inflation and giving these guys this money for free because they are far, far, far too big to fail. You and I are exactly the right size to fail, but not if we come together. Not if we come together in community. There's more of us than there are of them. We can make this happen. I just have every confidence. And 2020, what was the response to COVID? More debt, more money, and look at this, shows you that extreme level of overvaluation, higher than at any other time, even 1929. I mean, you really have to think about this because there is a pattern here. Can you see how this mimics this? That's not an accident. That is the plan. And the government taking on all of this debt is to repay that debt with dollars that have absolutely zero value. Part of the sound money strategy that we execute at Zang Enterprises is based upon the same strategy that the governments use. So let's just take advantage of what's happening because quite honestly, we cannot get out of the way. So we might as well just take advantage of it. So far this year, although I'm sure this is up a little bit higher, the S&P 500 is up 17% so far. So when you open up your 401k or your IRA and you've been invested in all of these ETFs or mutual funds, et cetera, you go, oh, look at this. Isn't it great? It's up. I'm going to leave my money in. I'm going to put more money in. I'm going to stay in the system. It's fabulous. Everything is fabulous. Oh, see, I have to sneeze, so that means what I'm saying is true. But largely attributed to just a handful of stocks tracking one theme, the Magnificent Seven, that is 7, and AI. That's really what's been moving these markets. Now, of course, it's broadening out. We're going to talk more about that. But for the other 493 stocks in the S&P 500, both earnings growth and shareholder returns have been more measured. But you can't see that when it's in an index. All you see is the index moving up or the index moving down, as the case may be. We'll talk more. In fact, as the team at Bank of America pointed out in a note on Tuesday, these remaining members of the S&P 500, so out of 500 companies, 7 are doing great, 493, meh, not so great. But of course, don't worry about that now because when interest rates go down, they'll be able to borrow more money and push up their stock prices even to higher valuation levels. No worries. But these remaining members of the S&P 500 have been in an earnings recession since the beginning of last year. And if they are dependent upon consumer spending, we're going to be talking more about the consumer. We got a problem. More and more zombie companies. But stock markets are extremely stressed in valuation, as you saw. Stock market to gross domestic product, the widest that it's ever been. Far more than the dot-com bubble in 99. Far more than the stock market before the stock market crashed in 1929. And what are the insiders doing? Well, they're getting out. I mean, come on. They understand that their shares and their stock is severely overvalued. Zuckerberg sold nearly $500 million of Meta stock in the last 2 months. Bezos to sell $5 billion of Amazon as shares hit record high. Sales come along for Zuckerberg alongside a 194% rise in Meta's stock price. Did you know you were in a gambling house in Vegas? Because at least if you go to Vegas and you put some money on the table, you understand that there's a really good chance that you're going to lose it. But there's a whole generation of investors since 2008 that have only known a manipulated market, a reflated, central bankers' terms, not mine, a reflated market that is in the process of crashing because there is a structural shift in the bond market, and I'm definitely talking more about that next week. But what do you think they might know that you don't? Because this is exactly the way that risk transfer happens. Those that know it, the few, transfer that risk to the many, and then it's the many that are left holding the bag when everything implodes. Well, let's see, because they're singing the tune, happy days are here again. Well, roaring 20s, and we know how that ended. Tech giants face tough task to sustain second half stock rally. Nvidia alone accounts for nearly 30% of the S&P 500's advance. So when you're investing in the index, all you're seeing is the index. You're not seeing the other 493 companies. Valuations are elevated and profit growth is poised to slow. But wait a minute, now they're saying that profit growth, no, happy days are here again. Yeah, no, profit growth are set to slow. The dominance of the tech sector, especially with gains concentrated within a few key companies, like 7, within a few key companies seen at the forefront of an AI revolution, suggests some parallels to the dot-com era, when euphoria over the internet preceded a bubble burst that took years to recover from. They want you to think this time is different. Do you think it's different? I don't think it's any different. It's never any different. But Wall Street's broadening trade imperils index tracking billions. So most people have opted for non-managed ETFs. Let's take a look at what's in those ETFs. We've talked about this before. It's that herding mentality. So these are ETFs: SPY, IVE, VV, VOO, VTI, QQQ. These all measure the stock market, but guess what? They're sitting on virtually zero cash if there is a run on these ETFs, right? No cash holdings hidden. I mean, you can go and look. I got all the links. You can go in and find out yourself. But from what I could find, there's absolutely zero cash holdings in any of these ETFs. They're all in stocks. So what happens if the market turns? What do you think is going to happen to the ETFs and your ability to get out of them? So if you're going to stay in them, rock and roll hoochie coo, but you better make sure that your portfolio is properly diversified and you have sound money outside of it to recoup any losses that you are going to sustain if that's where you're holding your wealth. In fact, 2 funds alone have more than $500 billion in assets. That's going to have a huge impact. Because what they're all invested in is essentially the same stocks in the portfolio and no cash for liquidations. There better not be a run. And what happens if there is a run? Boom, they will shut off your ability to liquidate. How is that going to impact you? And by the way, what could possibly go wrong? Isn't IA going to save everything? You know, Wall Street just needs the next hat to hang their hat on. Right? The next hook, rather, to hang their hat on and to justify severe overvaluations. And if you were around in 99 like I was, looking at these nosebleed level valuations, it made absolutely zero sense. And guess what? It makes no sense today. And what goes up must come down. A tree does not grow directly through the sky, even giant redwoods. So let's look at what could possibly go wrong. What you're looking at here is the 10 largest companies by market cap, right? So that's by shares traded, the valuation, the market valuation of their shares, whether they're a good valuation or not. But the top 10 companies now make up about 35% of the index, but only 23% of earnings. So going back to those 493 shares that have been in an earnings recession since 2022, 8 out of the 10 largest market cap companies are tech. It's all the usual players: Microsoft, Apple, Alphabet, Amazon, Nvidia, Meta, Broadcom, Tesla. Those are 8 out of the top 10 highest valued companies on the stock exchange, and those are all in all of those ETFs and ever so many more than what I showed you. What do you think about that? Because when a market corrects, I mean, it looks great on the way up, it pushes everything up. But when we have an implosion, it will drag everything down. Investors fled tech like rats from a sinking ship, says Kramer. And he just said that on the 11th, right? So what goes up must come down. This is how they hide it from you. You open up your statement, you're just looking at what the indexes are doing, and you think everything is hunky-dory, when in reality, if that's where you're holding your wealth, it's the most expensive market ever, and consumers are losing steam. We got a problem here. Because the spot gold market is well below its intrinsic value, even as it's making new highs. 2460 was the last time I saw it. I can't tell you what it's doing now. So this is really telling you that we had the breakout in the spot market. I've been talking about that for a while. We see it in the physical only market way before we see it in the manipulated spot market. But truthfully, how is gold doing against these other assets? Well, gold versus the S&P 500. Spot gold outperforms the S&P 500 that we were just talking about. Isn't that interesting? Did you know that? And it's still severely undervalued. A lot of people ask me about mining stocks. Owning mining stocks is more like owning a stock than it is like owning gold, because you really don't have any claim to the underlying gold. And so the mining stocks have underperformed. They're probably more fairly valued. I'm not telling you to go and buy mining stocks, because at this point in time, I like my wealth in tangible assets. That's my flight to safety, is in sound money. But I do get this question a lot. So I wanted you to be aware of this is a major gold mining index, and I want you to be aware of what's happening with it. But remember, we talked about a key pattern shift. This is a 53-year-old shift in the trend. That matters. And this is from bonds. So we looked at stocks, we're looking at bonds. We are in a structural bond bear market. Bonds are not a good hedge. Gold is taking over. So let me tell you, there is no fever like gold fever. None at all. And we are at the beginning of that. So we are also at the beginning of a stock market plunge. And I'm not saying that these markets can't go up from here. Keep in mind that in places like Venezuela and other places that have been experiencing hyperinflation, Zimbabwe, etc., at first their stock markets were Venezuela, 2013, 14, 15, the best performing stock market in the world, as their currency was hyperinflating and losing every bit of value. 1 trillion times zero is still zero. And all of these intangible financial assets are all made up of this. So if all you can convert it to is into this, you got a problem. That's why to have a properly diversified portfolio, you got to have physical gold, physical silver, sound money. But you also need to be as self-sufficient and independent as you can possibly be. So food, water, energy, security, barterability, wealth preservation, community, and shelter. Local community to ensure security and all those other avenues. Because together we are so much stronger than we are with just one. So we've got to come together. How do you do that? Well, you find meetup groups. You go to local farmers markets and you get to know who grows your food. You get to know your neighbors. Go out, knock on doors, be of value to everybody. And, am I saying talk to your neighbors about what's happening? You can, but you're more likely to find more like-minded people if you're going to a community garden or a meet-up, right? And it doesn't matter. I don't really talk to any of my neighbors about what I do unless they ask me, unless they bring it up. But I've still planted out my entire exterior of my property, and my neighbors come and they take a little food here and they take a little food there. This is important in building community. Globally, we have to come together in community so we can at least have a shot at having a seat at the table in the new monetary system, because we are already in that transition. Make no mistake about it. This is not something I'm waiting for. This is something I'm watching unfold. I want you to be as self-sufficient, independent, and have your freedom. And we can do that coming together in community. Globally, just all you have to do, here's a quiet, peaceful revolution. Convert your fiat money into sound money, gold and silver. Ta-dum, done. If enough of us do that, we got a shot. So make sure that you like this video. Do it on the way in. Actually, I should have said something in the beginning. Leave us a comment, share, share, share. Send any questions to questions@Lynette Zang. And I really appreciate you being here today. And now I will start to take questions. And I love questions. So help us grow this live event, because I really want to keep doing it. So we need to get this out there, because I'll answer all the questions. I'm an Energizer Bunny. I can keep going. So Donald Neese asks, how many ounces of silver should we hold? Okay, the amount of silver that you should hold is based upon your current cost of living and short-term barterable things like how much food you're currently spending money on, how much gasoline or energy you have, those kinds of things. So we have that all outlined. If you call and talk to one of our strategy specialists, then the first thing that they're going to ask you is about your goals, and one of the things would be to sustain your standard of living. I've made sure that I have enough silver, and I like a variety of sizes, and you'll see I really personally do not have anything larger at this point than 1 ounce. We've got some things in the fire though you're gonna love, so bear with me on that. Other than your scrap, some of your scrap sterling can be heavier than that, but would I mind clipping this off? Nah, it wouldn't bother me at all. So I have it based upon how much bartering, local bartering, I feel that I'm going to need to do for myself and both of my daughters. So there's no blanket answer for that, because it really is based on your particular circumstance. But we're happy to help you figure out what that is. We've got all the formulas in the spreadsheets. Easy peasy. And Amir Bilal Muhammad asks, hi Lynette, I am so confident that silver will skyrocket much better than gold. If I have $1,000, don't you think silver will make us earn more money? Why do you concentrate on gold rather than silver? These are all great questions, so let's take them one at a time. The first, and I'm glad that you're confident, and a lot of people do, because of that gold-silver ratio, do think that silver is more undervalued than gold, and perhaps it is. But silver is a monetary metal that straddles industrial as well as the financial market. And I've done so many studies, and I have one pulled up, so it'll probably take me 2 or 3 weeks to actually get through this. But I'm working gold and silver through inflation, hyperinflation, and deflation. But when you say that silver will skyrocket much better than gold, do you think silver will make us more money? More of this? Because when you say things like that, what I understand is that you're looking at it like a trade. And I don't look at gold and silver as a trade. I look at it as a strategy. And that's why in the sound money strategy that we execute at Zang Enterprises, we look at, well, how are you spending your current money now to sustain your current standard of living? And then that's how much silver, because I'm not going to convert it back into this. I'm going to convert, whoops, well, so much for that money gun, but I'm going to convert it into food if that's what I need to convert it into, right? So that's what it's based upon. I don't think of it as a trade. I am not going to be liquidating it because it hits $2,000 or it hits $100,000, which I know sounds outrageous. What do you mean $2,000? Well, quite honestly, that's the true fundamental value of an ounce of silver. So even at 30 bucks, 40 bucks, whatever, it's severely undervalued. And I can't tell you in nominal terms where it's going to head. Heck, it could end up $1 trillion. If I have a $10 trillion Zimbabwe note, where is it? Right here. Okay, Reserve Bank of Zimbabwe, and it says $10 trillion. And what does it say? I promise to pay the bearer on demand from the Reserve Bank of Zimbabwe. I'm a trillionaire in Zimbabwe. Do you know what I can buy with this? Nothing. $1 trillion, 10 trillion, a quadruple times zero is still zero. So in my studies, what I've discovered is that during these transitions, while we will see that gold-silver ratio get more narrow at some point, especially when they do those overnight revaluations, they do it against gold. Gold is the primary currency metal. Silver is the secondary currency metal. And when they do those overnight revaluations, they take this junk that has absolutely zero intrinsic value and they revalue it against this sound money that is used, well, both of these really are used in every single sector of the global economy. So I concentrate more on gold because I know that it historically simply does. There's over 4,800 examples of it, so that's good enough for me to say, no, I do have silver. Absolutely, I do for my day-to-day barterability. That's its function for me. But I have gold for wealth preservation and to convert into income-producing assets when the time is right. So that's why I focus more on gold than I do on silver, and I don't treat it like a trade. And Joao Octavio Fernandez asks, hi Lynette, when the price of gold goes up, is actually the dollar going down? Yep, exactly. Should the same apply in real estate? I mean, should the price of real estate stay the same in gold terms? And cheers from Australia, and I hope you're going to come and see me. I'm going to be there in November, and as soon as I have the specific details on that, I will let you guys know. So, well, real estate is a different kind of bird because it is clearly not a monetary metal, and also was most definitely, since it makes up roughly, and it varies place to place, but in general, right, makes up about 30% of the GDP in many, many countries, then the central banks have targeted real estate for reflation, right? So it's gold and you can look at gold and real estate because there are ratios like that. And what we know historically is that 25 ounces of gold can buy an entire city block, buildings and all. And I recently did a piece on gold and real estate. And Marie, would you, poor Adam is out sick today, and wonderful Marie is in here filming for us. But could you mark down to put the link to the gold and real estate in this video? So I just recently did one on gold and real estate. Real estate will be an opportunity. We need to see who's going to wash out, right? And we also need to see a cup formation on the bottom, because that cup formation is going to tell us when the smart money has begun to accumulate. And then because real estate is so severely overvalued, I mean, you know, who can really afford it other than the wealthy now, right? They've priced most people out of this market. It's severely overvalued. Gold, because a rising gold price is an indication of a failing currency. Gold is severely undervalued. That's going to flip-flop. And you're going to be able to take some of your gold, this is part of the sound money strategy, and convert it into income-producing real estate. And by that point, we're going to see where the dust settles. And we're going to be able to see where the smart money is buying. because I can tell you in Japan in the early 90s, which is what I think this is going to look like, commercial real estate dropped 95%. Now, you have the real estate drop and the gold go up like that. Can you see why 25 ounces of gold can buy a city block? It's not rocket science. It's just a repeat of history. And if you can learn to understand the patterns, then you know how to position yourself because you know what the next most likely outcome is. It really is that simple. And David Martinez asks, what will we do when we use our gold and silver to buy stuff and the government buys it off of the retailers to remove it from the market? Well, you know, there's gold and then there's gold and there's silver and then there's silver. So what you want to do is you want to have enough gold, and there's all different levels, right? So in my personal portfolio, Marie, how many stickers are there? Six different stickers for us? Yeah, I think there's 6. So there's 6 different levels of both gold and silver, depending upon what you're trying to accomplish. And, you know, while you can probably accomplish all of it to a degree with, say, something like this, although this is a pre-33 raw coin versus this is a 2024 eagle, gold eagle. You know, look, what I can tell you is I know that I have hammered in a nail in the wall so I could hang a picture, and it managed to work. But it definitely works a whole lot better when I have a hammer. So I've done studies on all these different levels and what works best for different functions. This is why I say the first thing you always want to talk about are your goals and what you're trying to accomplish. And then let that be a guide. You also have to look at your circumstances. Okay, what is your current cost of living and what are you trying to sustain in there? So we look at everything and then we can create a strategy that supports what you're trying to accomplish. And just because I don't get to, and we're really working on figuring this out, just because I don't get to talk about the mantra parts as much as I like to on YouTube because it kills the algorithm, and we're really working hard to build this channel so we have a greater impact. We are going to be doing more of that on social media, and we are going to be doing more of that on our website. So stay tuned because frankly, we want to be there for all of those different parts and whatever it is you need from us and however we can be of service to you because that's who we work for. We work for you. It really is that simple. And HC asks, hi Lynette, I know if you hold stocks in a brokerage account, it is held in street name. If you own stocks in a direct registry, is this better? And how would the economic crash affect these stocks? So just to clarify for those that might not be familiar with it, but when you hold stocks or ETFs or anything you hold in a brokerage account in street name, then what that means is that you've given the brokerage the ability and the right to use your equity for their benefit, and we can certainly see that banks love trading, right? So they are taking risk with your equity. In many ways, yes, it is better to hold it in a direct registry, which means that you are holding those shares at the company. But there has been a significant move to eliminate your ability to do that. Is it better? Sure. You can even take direct possession if they allow it. I mean, again, there's been a shift away from it because banks like to hold things in street names so they have more equity of yours to work with. But their preference is not for you to hold it yourself. So in a direct registry, banks would not have the ability, or if you hold the certificate, banks would not have the ability to use your equity for their benefits. So do I think that's better? Absolutely, I think that's better. And then the last part of that, how would the economic crash affect these stocks? Well, when the nominal price, what you see of the stock goes down, whether you hold it in street name or whether you hold it directly, It all moves. I was there in 1987 on Black Monday. Best day I could have ever been a stockbroker. Hands down, absolutely. And I can tell you that stocks that I had been told, because I was a newbie, right? I didn't really understand how to read the language of the markets at that time. And I was told how rock solid and awesome these stocks were. Guess what? They went down too. So, and it's kind of a double whammy, because not only is their nominal price imploding, but you got central banks devaluing the currency as well. It's a double whammy. So, personally, at this moment in time, I own 0 stocks. I own 0 bonds. I have this stuff because that's your first line of defense, because it's the most recognizable. But I have enough that I can cover some things because I'm running a business. I have to make sure that I can pay salary and pay my bills. So I have a certain level of cash as my very first line of defense. And it's based upon, again, my costs of doing business, my costs of carry. Then I have a certain level of silver as my second line of defense to ensure that I'll be able to put a gallon of gas in my car and buy strawberries if that's what I need or whatever. Then I have my barterable gold, so different sizes. I have my barterable gold to make sure that I can pay my property taxes. So you see, there's all different reasons, and every reason that you have, every goal that you have is supported by something different in gold and silver. And we help you figure out what those goals are, understand what your circumstances are, and then build a strategy to support what you're trying to accomplish. It really is that simple. So, and I love our phone number. We love contact, but it's G833-GLD-ZANG. So very easy to remember. And Jules F asks, Lynette, I know the stock markets are going up, day traders. When they see things crash, how the heck do they get their money out of the market? Are those day traders also asleep? Well, the day traders, they've got to be on top of it all the time. And the beauty part about technicals is you can look at it long term, which is my personal preference. And you can also look at it short term and then be able to make an educated choice on which direction they're going. But day traders are not really strategists. They're just looking for a little pickup. And this whole market, can we go back to that first chart, Marie? And this is the one that I want you to look at, right? And if I can I don't think I can, because I have to pull the whole thing down. But this has been converted. This is the financialization of the markets, where Wall Street becomes more important than Main Street. And everything, including air, including water, which are necessities. You gotta breathe, you gotta have water, you gotta have food. Everything has been turned into a trading vehicle. That is actually what this graph is showing you, and how unrealistic it is, because guess what goes into the GDP? Inflation. So it's a big fat lie, but it's severely overvalued. So day trading is just about a little pickup in money. They don't care. And when it implodes, they are the first rats to leave that sinking ship. And they have all of the stops put in there to trigger things. And when they get triggered, what that does is that means more things need to be sold. And so it's that herding impact, which looks great on the way up, but can collapse everything on the way down. So what you're going to see when that happens is you're going to see your inability to trade out of the stock market. But the traders are going to get out first, because they have a very short term. They're sitting right on top of it, and they're going to force the markets down more and more and more. Because let's say we get a stock market drop. All of this, well, not all of it, but a big chunk of all of this trading has been done on margin. So borrowing money to buy stocks. They keep going up. That means on that same stock, they can borrow more and more and more and more and more. So more and more leverage. That's leverage. Then when it goes down, what do they get? They get margin calls. In other words, you got to come up with more money or we're going to have to sell off parts of your portfolio. So there could be a huge implosion like there was on Black Monday in 1987. I mean, nobody talked about that happening. Nobody. I went out to lunch in the morning. I came back and oh my God, that place was on fire just that fast. I think they would be more apt to shut the markets down and eliminate your ability to get out. That's what we're seeing. That's what's going to happen in the ETFs. So you go in the ETFs and you want out, well, you better want out when not everybody else wants out because you're going to have a problem. They don't have any cash. They can't pay you out. And Deja Vu asks, where do you see BRICS going? Gold backed? Well, ultimately, to regain public confidence, everything will have some level of gold backing. I don't, but here's the thing. And really, you watch Zimbabwe, but here's the thing. Once you put gold as a component in there, then you are fixing the level of debt which is not payable. It is simply not payable. Not forget the sustainability and all of that. So I think ultimately, yeah, all currencies are going to be gold back, not at 100%, but at some level. But until you can convert it into the gold, don't believe it. It ain't done yet. Will the BRICS do it first? I don't know. I'm watching Zimbabwe because Zimbabwe has actually done it. What the BRICS have been saying so far is that it is about cross-border trade in local currencies. So yuan for yuan or yen rather, yuan for yen, or the Indian currency, or whatever it is. They may be behind closed doors talking about gold backing, and ultimately, yeah, I do think that that's where they're going to go. But they're going to have to hyperinflate and burn off this debt first, because that's what gold does. It requires fiscal responsibility, and I don't see any country that's really ready for true fiscal responsibility. Maybe Zimbabwe, I don't know. We'll see. And Luis Fernandez asks, what can I do with my 401k issued by my employer? Keep contributing as they match up to 5%. Yes, and check with your administrator and see if your employer has oh my God, it just flew out of my brain. I say it all the time. I say it very regularly. In service withdrawal roll over election. I'll repeat that. You want to ask your administrator if you have an in-service withdrawal rollover election, because what that'll do is that'll allow you to take a certain percentage up to you, and I don't know what it is now because I haven't looked at it lately, so you can't hold me to this, but typically up to $50,000 to move into a self-directed IRA. When you move it into a self-directed IRA, then you can take a distribution, you can pay your taxes, you can pay your penalties, and you can go completely private. And part of the strategy is how you recoup all of those taxes and fees and costs and all of that stuff. That's all part of the strategy. So you might be able to do that in your 401k, because if you're currently contributing, you're not likely to be able to take it all out. You might have the ability also to borrow against it. So that's one way to do it. And then what you're doing is paying yourself back. So that's another way to gain access to it. So, there's not a whole lot you can do when you're currently contributing. They're paying 5%. I don't know what your circumstances are, so they're matching, so that gets you a little bit of flexibility. But when we get a market implosion, it's going to implode way more than that 5% or that 10% contribution. You have to do what you're comfortable doing. I can't tell you, I can tell you what I'm doing. I can't tell you what to do. But think about it and see if there's some way if you can move some of that money and then get private and get invisible and become your own central bank. And Rod Kasnick asks, when you say owning gold gets you a seat at the table, what exactly does that mean? Well, I want to have a say. I want us to have a say in the new monetary system, because what they have in mind for us is full surveillance and full control. We want to have a component of gold in the new monetary system because it requires fiscal responsibility. So even though after they do it, they'll start to remove that, at least we'll have a minute that will require them to have more fiscal responsibility. But for me, what it means is a seat at the table is I want us to have the ability to have a say in the new monetary system, and that this new monetary system has a much bigger level of gold in there and has requires governments to be, I don't know, fiscally responsible. So that's what I mean. I just want us to have a say. And if we come together, I mean, look at what's happened with the unions. Look at what's happening with the protests in China, right? If we come together, we got a shot at that. So make sure that you subscribe, share, leave us comments, give us thumbs up on the way into the videos. Make sure you encourage others to join us Tuesday at Live. And and we also have done a lot of videos, and for those in Australia, on the digital assets and the conversion to cashless and all of that. It's very important. And share what your experiences are, boots on the ground, because all I can do is look at it from here. But when you guys, email us at, well, you can send it into questions at LynetteZang.com and just put it, please get this to Lynette, and they'll get it over to me so that I know what's really happening where you are and how you guys feel about it. Because everybody at Zang Enterprises is here to be of service. Every single one of us. It's one of the things that I feel so proud about as we're building our team. What a powerful team we have. And you can visit us at LynetteZang.com because you want to make sure that you are prepared before you need to be prepared. And I can't tell you when that moment is, but that pivot that the markets are so excited about, that means something awful is happening. That's what that really means. And we are on the precipice. I've studied currencies and currencies life cycles like 1987. There isn't one teeny weeny, not any doubt in my mind, because I'm watching it unfold in real time, and so are you. So thank you so much for all of your support, for coming and joining us. Help us grow this live event. We should have thousands of people at this event. That's the goal. And until next we meet, I totally know that together we can make a positive difference for a lot of people around the world. This is a global issue. We are a global people. And I'll see you soon. So until next we meet, please be careful out there. Bye-bye.